Hey everyone, welcome back to the Money Talks with Andy channel. So today I wanted to cover a topic, and that's stock options basics. And I'll explain some of the most basic terms in stock options, okay? So let's dive right into it. And you probably want to stay till the end where I give you an update on my most recent stock options trade. Okay, so they'll be right at the end. So, what style? Not Gangnam style. Okay, there's two styles of options, and you need to know exactly what you're doing. Otherwise, you could get seriously burnt. Oh, don't forget, this is not investment advice. Anything I discuss, um, you know, is just for entertainment purposes only. Do your own due diligence. Make sure you cover your risk. So let's crack on. So what style of options? There's the American style and the European style. The American style option, the option contract, can be exercised at any time between the date of purchase and the date of expiration. Okay, that should be date of expiration. All right, and usually there's a tiny bit of time after the market closes. So for example, if the market closes at 4 o'clock Eastern Time, New York time, there's maybe 1.5 to 2 hours that the contract buyer who bought the option, that person might have a bit more time to decide whether he wants to exercise the contract or not. So that's American style option. The other one is European style option, where it's only allowed to be exercised at the date of expiration. You cannot do it anytime in between the purchase and the date of expiration. It can only be exercised at the expiration date. All right. Now, something that always confuses people, it certainly confused me. What are we doing? Are we buying, selling? What's a call? What's a put? Okay, so there's two sides to the options contract. There's a buyer, there's a seller. What are they buying? They are either buying a call or a put. All right, so let's start with the option buyer, the buyer of the option contract. So the buyer has the right, not the obligation, to exercise the contracts up to the date of expiration. The buyer pays a premium. All right. The opposite to that is the seller of the option contract. The seller has the obligation, okay, to fulfill the contract, to deliver on the contract, if the buyer decides to exercise his or her rights. And again, it depends on what kind of option style, American or European. In this case, the American style, you can do it anytime between the date you buy the contract all the way up to the date of expiration. Okay, the seller of the contract, because he or she has the obligation to deliver on the contract, will collect a premium. So the buyer pays the premium, the seller collects the premium. All right, and the premium is basically just a fee for this contract. All right. Now the call option is where a buyer expects the price to move up. A put option is where the buyer expects to move down. All right. Strike price. This is hopefully quite easily understood, but it's basically the agreed price at which the buyer and seller will either buy or sell a stock. Okay. Days to expiration, or sometimes referred to as DTE, is the number of days before the contract expires. So, US style options, it's actually quite basic. I've summarized it here. Okay. Call buyers have the right to buy at a strike price. Put buyers have the right to sell at a strike price. Call sellers have the obligation to sell at the strike price, which is the opposite of number one. Okay. And put sellers have the obligation to buy at a strike price, which is the opposite of number two. Okay, so feel free to screenshot this or write it down, pause the video, do what you need to do. And by the way, if you're enjoying this video, give me a like, subscribe to the channel. Let's continue. So what's one way I use to trade options, okay? So what I do is I sell covered calls, which lowers my cost basis on stocks I want to own long term, okay? Now it's covered, meaning I physically own the shares. So I've actually got the shares in my brokerage account before I sell the contract. So I've got the shares before I sell a contract. And the contract I sell obligates me to sell at an agreed strike price by an agreed date, okay? And I only do this on fundamentally strong stocks or companies only. Do not do anything with options if you don't know what you're doing, and you definitely do not want to sell any contracts on companies that you're not prepared to own, okay? Factors that make up good fundamentals, this is just my opinion. I think typically just the usual suspects, I guess. Low to no debt, lots of assets that you can sell in the event of a forced sale or liquidation of some kind, growing sales or revenue, growing cash flow, good management team, and this is, for me, the most important point, a proven track record of 5 to 10 plus years. Because my opinion is, if the company's done well, it will hopefully continue to do well. Again, this is not investment advice, but you always see the disclaimers at the end of most financial statements. You know, past performance is not a guarantee of future performance, but in my view, past performance is a critical factor for me in assessing whether a company will continue to perform well. Okay, I also use technical indicators. I use a few, but for long-term investments, generally I try and look to see that there is a clear uptrend. Okay, so finally, just some resources I wanted to leave you with. I hope you don't mind, but it's really obvious. This is how many people get their information as well, I'm sure. YouTube, Google, any search engine. What you want to do is just search for stock options or stock options basics. If anyone wants additional channels or resources that I personally use, drop a comment. I will happily share what I use. Other than that, you know, feel free to do a search on your favorite search engine. So finally, before we finish up, the update on my personal stock option trades. So as I mentioned, I like selling covered calls. So I sold a covered call, which obligates me to sell my shares. Okay, I've already got the shares, all right? I've already got the shares. So I sold the contract at $24.50 strike price. So I'm obliged to sell my shares at $24.50. The price went up to $25.30 at the end of the contract. So guess what? My shares got called away. So the shares physically left my brokerage account. 100 shares went to zero, and I received cash for these 100 shares at $24.50 each, because that was the strike price I agreed to sell at. So I sold my $24.50, and I received cash of $2,450. So recall, in the previous video, I'll put a link up, but I collected a premium when I sold this contract, so I collected $75. So I know I missed out on the upside, so it's gone to $25.30. Who knows what it is today, you know, but I have locked in the premium and the strike price at which I sold my shares. Overall, I got about 3% in 28 days. So there we go, that's the update. And that is stock options basics explained. There are a lot more things to stock options. I'll hopefully cover some of this over the coming weeks, but this should hopefully get you started. If you enjoyed the video, give me a like, subscribe to the channel. Until next time, have a great day, everyone.